You spent 40 years paying into Medicare through your paycheck. The promise was simple: pay in while you work, and the system will cover you in retirement. Then the first bill arrives. Your premium isn't $202.90 a month, like the brochure said. It's $405.80. Your spouse's is the same, almost $5,000 in extra Medicare surcharges for the year, on top of the base premium you already pay. That surcharge has a name, IRMAA, the income-related monthly adjustment amount. And the part nobody told you is that this isn't a separate tax. It's the same dollar of income being assessed twice. Once by the IRS the year you earned it, once by Medicare 2 years later. Most retirees pay it for years before they understand what's happening. This video will show you how to avoid ending up like them. In the next 10 minutes, I'll walk you through exactly how IRMAA works in 2026 and beyond, the 2-year look back that creates the timing trap, the 5-tier cliff structure that punishes you for being $1 over a threshold, and the 4 planning moments where a normal looking financial decision can trigger surcharges you weren't expecting. Then I'll show you the 4-quadrant decision framework that tells you whether IRMAA can be avoided, reduced, appealed, or has to be accepted based on which planning moment you're in. If you're approaching Medicare, you can prevent most of it. If you've already hit IRMAA, there are appeals that work in specific circumstances most retirees will never use. If you're 63 or older and you've saved meaningfully for retirement, anywhere from $1 million to $10 million, IRMAA is going to affect you. It probably already has, possibly without you noticing. For a married couple in 2026, surcharges range from about $1,950 a year at the first tier to over $11,700 a year at the top tier. Just for Medicare Part B, add Part D surcharges and the top tier numbers go even higher. But the dollar amount in any single year isn't the bigger problem. The bigger problem is that single $80,000 Roth conversion in 2024 can trigger surcharges in 2026 that you can't see coming until they arrive because of a 2-year look back that almost no advisor walks through with their clients. Households with pensions, large RMDs, and huge unrealized capital gains hit IRMAA more by accident than most retirees because they are making one decision that did not account for what is coming. I'm Ryan Knoll, founder of Nav Wealth Partners. We specialize in helping retirees pay less taxes in retirement. IRMAA is the surcharge clients ask us about most often after they've already been hit by it. Let me show you why almost everyone gets surprised and what you can do about it. IRMAA is the surcharge added to your Medicare Part B and Part D premiums when your income exceeds certain thresholds. The base Medicare Part B premium in 2026 is $202.90, and that's per month per person. That's what most people expect to pay. Once your modified adjusted gross income crosses the threshold, that number jumps. For a married couple filing jointly in 2026, the first IRMAA tier starts at $218,001 of modified adjusted gross income on your 2024 tax return. There are 5 tiers in total. Quick walkthrough, married filing jointly 2026 numbers are as follows. Tier 1, it's $218,001 to $274,000, and the surcharge runs at about $975 per person each year. Tier 2 is $274,000 to $342,000, and that's about a $2,400 a year per person surcharge on top of the base premium. And then Tier 3 is $342,000 to $410,000. That's about a $3,900 a year per person penalty. And for single filers, those first 3 tiers are exactly half of those amounts. Tier 4 is $410,000 to $750,000 for married filers, and $205,000 to $499,999 for single filers. And that's about a $5,300 a year penalty. And then finally at Tier 5, it's above $750,000 for married couples and above $500,000 for singles, and that's about a $5,950 a year surcharge. And that's just the Part B surcharges, which happen to be a little bit more expensive. Part D adds even more on top of it, but not by as large of a margin. These numbers adjust annually for inflation. The brackets in 2027 are likely to be slightly higher. The structure stays the same though. 3 things about that structure matter more than the dollar amounts. First, the 2-year look back. Medicare looks at your 2024 tax return to determine your 2026 premium. Your 2025 return will determine next year's premium. So today's planning decisions affect tomorrow's premiums on a delayed schedule that almost no retiree internalizes. Most people only learn IRMAA exists when the first bill arrives in retirement, at which point the decision that triggered it is 2 years ago in the past. Second, IRMAA is a cliff, not a ramp. The thresholds aren't graduated. Being just $1 over the threshold creates the same surcharge as being $20,000 over. A couple at $218,000 of modified adjusted gross income pays no surcharge. A couple with $218,001, they pay $1,950 more for the year, the same dollar of income. Third, IRMAA is recalculated every year. If your income normalizes, IRMAA normalizes 2 years later. It's not a multi-year penalty from one bad year, but it does mean high-income years cast a delayed shadow you may not see coming. And that's the structure. Now let me show you why it functions as a tax assessed twice on the same income. This is where the title of the video comes from. Let me walk $1 of income through both assessments. Take a $50,000 Roth conversion executed in 2024. A married couple in the 22% bracket pays roughly $11,000 of federal income tax on that conversion. That's the first assessment. It happened in 2024. It was paid in 2025 when the return is filed. The same $50,000 of income flows into Medicare's 2026 IRMAA calculation 2 years later. Say this couple's modified adjusted gross income was sitting at about $230,000 before the conversion, already past the first IRMAA threshold tier in Tier 1. The $50,000 conversion pushes them to about $280,000. That crosses into Tier 2. Here's the part nobody modeled. Their Medicare surcharge for 2026 climbs by roughly $4,800 for the year. Some of that they'd have owed anyway for being in Tier 1. But the conversion is what carried them across the next cliff. And the cliff is where the damage compounds. That's additional Medicare premium triggered by the same $50,000 of income they already paid $11,000 of federal tax on. That's the second assessment. Same dollar of income, different agency, different timeline, a different bill arriving 2 years after the first one. So the conversion didn't cost $11,000, it cost $11,000 of federal tax plus thousands more in Medicare surcharges 2 years apart. Once you stack the IRMAA hit on top of the income tax, the effective rate on that conversion isn't 22%, it's north of 30%, and that's the gap. The gap between what the Roth conversion math says the conversion costs and what it actually costs once IRMAA stacks on top. That's the planning gap most retirees never see. The bracket fill software that tells you to fill the 22% bracket doesn't model IRMAA forward. The conversation that should be happening, this conversion is going to push you across the IRMAA cliff and cost you thousands in extra Medicare premiums 2 years from now. So are we sure we want to do this? That usually doesn't happen. You're not paying tax twice in the literal sense, but you're being assessed twice on the same dollar of income. The federal return books it once, Medicare rebooks it 2 years later. The double assessment is the structural mechanic that turns IRMAA into something every Medicare eligible retiree has to plan around, not as a one-time surprise, but as a permanent factor sitting inside every income decision. Let me show you what this looks like for a typical household. A 64-year-old couple with, let's say, $3.2 million saved across IRAs and brokerage accounts and Roth comes in. They've recently retired. They knew about Roth conversions. They worked with an advisor who recommended a 5-year conversion plan filling the 24% bracket. Year 1 of conversions executed in 2024. They converted $130,000 from their traditional IRA to their Roth. Their modified adjusted gross income for the year, including the conversion, Social Security, pension, and portfolio income, landed at $278,000. That's $4,000 over the Tier 2 threshold. Federal tax on the conversion was roughly $31,000 at the 24% bracket, and they expected that. What they didn't plan for in 2026, 2 years later, their Medicare premium notices arrived showing the Tier 2 surcharge, about $4,870 in additional Medicare premiums for the year. That's $2,920 above the Tier 1 surcharge they would have paid if the conversion had only been $4,000 smaller. If they'd capped that conversion at $126,000 instead of $130,000, staying just under that threshold and a very immaterial difference, they would have saved $2,920 in 2026 Medicare surcharges. So essentially that extra $4,000, nearly $3,000 was eaten up by the surcharges itself. When I showed them the comparison, the husband looked at me and said, "We did the same thing last year too, so now I have to pay this again next year." And that's the moment I want every person watching to understand. The mistake typically costs you twice. 2 years after the first conversion, and again the year after, because you didn't know you made the mistake until you made it twice when it showed up on that first year's IRMAA surcharge. And it wasn't malicious. Their advisor's bracket fill software said the conversion was good. The IRMAA calculation didn't run because that lives in a different tool, or the tool was optimizing for the wrong variable. The conversation that would have caught this threshold cross, this conversion is putting you $4,000 into Tier 2 surcharge in 2026, let's cap it lower, that never happened. The fix going forward is to cap conversions at the level that keeps modified adjusted gross income below the next tier threshold each year. Move any excess capacity into different techniques, direct indexing for harvested losses, qualified charitable distributions, deferred conversions for years when income would naturally drop. That's the same strategy calibrated to both assessments instead of just the first one. If your situation looks like this couple's, meaningful Roth conversion activity in your early retirement years, modified adjusted gross income hovering near the tier thresholds, the double assessment is sitting underneath your plan right now, whether or not anyone has shown it to you. And I'll be honest with you, most financial advisors don't run the IRMAA projection forward when they recommend Roth conversions, because the income tax projection runs in one tool, and the Medicare premium projection runs in a completely different one. The two systems don't talk to each other. The clients I work with who got hit with a surprise IRMAA usually had advisors doing competent income tax planning. The IRMAA wasn't on the radar because the tools didn't put it there. The conversation that should have happened, this conversion is going to cost you $2,900 in Medicare surcharges 2 years from now, are we sure, didn't happen because nobody was modeling forward to the second assessment. That's what frustrates me about how this part of the system works. The information gap isn't because anyone's hiding the math. It's because the math lives in two different systems run by two different agencies on two different timelines. And the people paying the gap are retirees who did everything right. You saved diligently, you worked with an advisor, you followed the conventional Roth conversion wisdom. You got assessed twice on income you thought you'd already handled. You deserve advice that runs both assessments together, not separately, on different days in different software. Before I show you the framework that tells you exactly which action applies to your specific situation, I want to explain why this mistake gets made so often by accident. When you pay federal income taxes, they're paid on taxable income. And taxable income is all of your income added up, which is known as your adjusted gross income, less the greater of your standard or itemized deductions. So a married couple who has a $100,000 pension, $30,000 of portfolio income, and $50,000 of taxable Social Security has adjusted gross income of $180,000. For simplicity, we'll say that they're both 65 or older and take their standard deduction of $35,500 this year. Their taxable income at this point is $144,500. Now, they've modeled a strategy with their advisor that if they convert $35,000 to $40,000 a year from their 401k to Roth, they'll never pay taxes above the 22% bracket. So to be safe, they convert at the higher end and do $40,000 because their investments have been outperforming recently. In this instance, adjusted gross income increased by $40,000 to $220,000. They take out their standard deduction of $35,500, and taxable income is $184,500, which is well below the $211,000 top of the 22% tax bracket. So everything sounds good and according to plan, right? Well, what this couple's advisor did not model is IRMAA. And IRMAA is based on a different number called modified adjusted gross income. Modified adjusted gross income is your adjusted gross income plus tax-exempt interest, plus certain exclusions and add-backs for U.S. savings bond and foreign earned income. For simplicity, let's revisit our couple and assume they had no add-backs. So when we calculate their adjusted gross income, they have the original $180,000 from their pensions, their portfolio, and their taxable Social Security benefits, plus another $40,000 in conversions. Modified adjusted gross income in this instance is $220,000. $2,000 over the first threshold. This results in IRMAA surcharges of $975 for each of them, which is $1,950 total, which wipes away the last $2,000 they converted. So had they converted that $2,000 less, still within their plan range, they would have saved that money. Instead, by converting, they essentially lit it on fire because they're not aware of the nuance between taxable income and modified adjusted gross income. Now, let's show you the four-quadrant decision matrix to help you avoid this altogether. So there's 4 planning moments and 4 corresponding actions to find which quadrant you're in. Quadrant 1 is you haven't hit IRMAA yet, and your concern is ongoing income. This is the prevention quadrant. You have time to cap your Roth conversions at the level that keeps modified adjusted gross income below the next tier threshold each year. Use direct indexing to generate harvested losses that offset conversion income. Use qualified charitable distributions if you give to charity, because QCDs don't appear in your modified adjusted gross income at all. The full toolkit applies because you can model the next several years forward. Then there's quadrant 2, where you haven't hit IRMAA yet, but a one-time event is coming. The sale of a business, a stock option exercise, large capital gains from selling a long-held position. The strategy here is a bit different. Instead of trying to avoid the income, accelerate other planning into the same year. Bunch charitable giving, realize losses, time other income events to share the IRMAA hit you couldn't avoid anyways. The cliff structure means you're paying the full tier 3 or tier 4 surcharge, whether you cross it by $1 or $20,000. So if you have to cross with the most income consolidated into that bracket for the year. Quadrant 3, you've already hit IRMAA and the trigger is recurring income. The fix is forward-looking. Restructure the income picture for next year so the look back into the next year produces a lower surcharge 2 years out. The clock keeps running, and reducing income now produces relief in 24 months. Same toolkit as Quadrant 1, but applied 2 years later. And then there's Quadrant 4. You've already hit IRMAA from a one-time event. This is where the appeals process matters. Most retirees never use it. The Social Security Administration accepts appeals for life-changing events. Retirement itself, death of a spouse, divorce, work stoppage, work reduction, loss of pension, loss of income-producing property, those are all triggers. If your IRMAA was triggered by a one-time event and your current income is meaningfully lower, you file Form SSA-44. Document the life-changing event, show the reduction in current income. The surcharge can be reduced or removed for the affected year. The appeal isn't guaranteed, but it's substantially more available now than most retirees know. We had a potential client who came to us after her husband passed away. He'd worked 30 years and had a pension that, combined with both their Social Security benefits and the income off their portfolio, put them comfortably into the 4th tier of IRMAA. While he was alive, that was just the cost of a good retirement. When he passed, the pension dropped to a reduced survivor benefit and his Social Security check stopped. She keeps the higher of the two Social Security checks, but not both. Her income fell by more than half. But here's the trap most people miss. The year after a spouse dies, the survivor files as a single taxpayer, and single IRMAA thresholds are half the married thresholds. So even as her income collapsed, the line she was measured against dropped right along with it. On paper, the widow's penalty can keep you stuck in a high tier even after the income that put you there is gone. We caught it building her financial plan, then worked with her accountant to file the Form SSA-44 documenting her husband's death as the life-changing event and showing Social Security her actual reduced current income instead of the 2-year-old joint return. It got approved. For that year, it pulled her from the 4th tier down to the 2nd. That was a little over $3,000 in surcharges she got back, Part B and Part D combined. And because her income stays lower going forward, that's not a one-time win. It resets the baseline. The form took an afternoon. Almost no one knows it exists. What you need to do now is run the 4th quadrant test on yourself. The right action depends entirely on the quadrant. Quadrant 1 and Quadrant 3 require the most planning. Quadrants 2 and 4 require knowing the rules and how to use them around one-off situations. This is how you save thousands of dollars each year in surcharges. If you want to see how IRMAA fits into the broader retirement income picture, how it interacts with your Roth conversion strategy, your Social Security timing, and your withdrawal sequencing, I put together a free retirement income architecture blueprint. The double assessment math is one section of it. Link in the description below. IRMAA isn't a separate tax. It's the same dollar of income assessed twice by 2 different agencies on 2 different timelines. Most retirees don't know that's what's happening. They just see the bill and feel punished for saving. The system isn't punishing you, it's billing you twice on income you thought you'd already handled. You're wealthy enough that IRMAA will affect almost every decision in your retirement, but you're not wealthy enough to ignore the difference between paying it and paying it twice. The 4 quadrants take 5 minutes to run. Do it this week. If you haven't hit IRMAA yet, identify which planning moment is coming and which action prevents the cliff. If you've already hit IRMAA, identify whether the appeal applies to your situation. Either way, you'll know more than you did this morning. If you'd like to model your specific picture, what your projected modified adjusted gross income looks like at each conversion year, how it interacts with the tier thresholds, whether the appeal applies if you are already hit, There's a link in the description to my team's calendar. My team runs this analysis as part of every retirement plan we build. The double assessment math sits underneath every Roth conversion decision, every withdrawal sequencing choice, every charitable giving plan we model. If it's worth bringing into your plan, we'll show you exactly which tier you're in and what changes that picture. If your current plan is already calibrated to it, you'll leave the call with a confirmation. The Medicare system isn't going to call you and explain this. The advisors who weren't trained to model it aren't going to volunteer it. The only way to plan around the double assessment is to know it's there. Now you know.